Good afternoon. Welcome to today's market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at the four major market ETFs or indices through their ETFs, we'll take a quick look at the US dollar. We'll look at oil, gold, silver, and then we'll move on to chart requests. Those of you that are in here, if you have a chart you want me to take a look at, feel free to type it into the chat tab, and I'll make sure to go ahead and take a look at it once we finish reviewing the markets. If you like what you see here, you can always follow me on Twitter at StockDarts. You can find these videos at YouTube under StockDarts, or you could visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, as well as just kind of expanding on a lot of the ideas and informations we come across during these Wednesday market reviews. So typically, for those of you that maybe are unaware of my process, I like to analyze what kind of market environment we're in, and from there I try to pick trade styles and trade ideas that match that. So if we're in a bull market, I tend to try to match my trades that way, which we are right now. So looking long and not trying to short the market. If we're in a bear market, then I'm looking at trying to take shorts or just trying to hedge risk as much as possible for trades that are on the long side. And then, same thing, again, if we're in a range-bound environment, then I'm looking at those types of trades, usually through premium selling and that sort of thing. So the idea is you want to make sure that you're using the right types of trades for the right type of environment. And so what we do on Wednesdays is we try to dissect the market and figure out what type of environment we're in. And so that's what we're going to go ahead and try to do. Fat Boys, welcome. Glad you're in here. We will definitely take a look at those when we get a chance. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500, and we're going to look at the ETF SPY. For those of you that were here last week, you'll know we were pretty bullish. We were expecting a market rally. That's actually been the case for a few weeks now. And as you can see on this chart of the S&P 500, we have broken out, and we're climbing upwards pretty steadily. The moving averages that we alluded to during the last couple of Wednesday market streams, they've continued to spread out. They've continued to rise, again, showing this trend that's starting to build up. And, it's all systems go. We're in a bull market. We're in a rally phase at the moment, and until we see something change, we have to assume that this is going to continue. Now, we do have a red candle today. It's not a big deal. I don't think it's really anything more than probably profit taking, but what we have here is we have one of these little upward drifts starting to occur in the on the SPY, right? And so when you get this sort of thing, I think the one takeaway you want to have from a chart like this is you don't want to chase price action. Now, the problem here is this can persist for a while, right? And we've seen this type of price action before. Matter of fact, if we come all the way back here and just take a look at August, you can see that we drifted up for quite a few days in a row before we eventually had a correction. And actually, if you really want to look back, we had three ascending wedges that all kind of came up all together. So sometimes these patterns can persist for a while. And if you really look at it, this is almost analogous, almost completely the same as what we started to see back here, where we had a triangle consolidation range, and then we started to break out, and you can see we drifted upwards, and then eventually kind of corrected for a week or so, but didn't really go backwards. We just kind of traded sideways, and then we had the same sort of upwards movement. And that's what we're starting to get again. Now, again, this is a pattern that persists in the market quite a bit. If we go back and we take a look at before the whole coronavirus mess that kind of put a real dent in the price action in March, but if we come back all the way and we kind of erase that and we see what the price action was prior to that, you can see we had very similar price action again, where we had this, you have this period of consolidation, and then as you start to bump up and start to break out, and so this is kind of where we are compared to where we were back in 2019 compared to now. You have a market that was trading sideways for a bit, and then it starts to break out. And as it breaks out, you can see sometimes you get these extended moves upwards without any real correction, and you might think to yourself, well, that means we're going to correct sharply at some point. And yes, that's going to, eventually it will, but these kind of patterns, they can continue, and this kind of buying pressure, it can continue to grab a hold of the market for a while. And so what you end up getting sometimes is you get a string of these rising wedges or these rising channels. And so you can see the very first one from back in October and November of last year, it kind of continued, and then eventually we had a little bit of a sell-off, but it really wasn't much. You can see we had 3 or 4 red candles, then we drifted up, and then we had a 2-day drop that put us back down to support, but we never really went backwards in the market. And then eventually that kind of built up into another rising wedge, which eventually had a decent price correction, and then we continued again, and then bam, finally we have a major correction. And of course that had a lot to do with news. It wasn't just the price action. And so this idea of these rising channels or these rising wedges leading to a quick and swift correction, that does happen eventually, more often than not, but it doesn't happen right away. And so at this point, it's very early in the life cycle of this new pattern, and with the moving averages branching out like this, I imagine even if we do see more red candles, it's going to be sideways correction rather than a correction down in price and through a lot of these support zones that we're looking at. So at the moment, I'm not that concerned with a pullback. I think again we've done a really good job of building upon this major red candle here. This was a big candle. This was the day of that Pfizer releasing the news on their vaccine. We had a really emotional gap up on Monday morning, and it faded the entire day, and that becomes an anchor point and a reference point for market participants. And as you can see, we kind of traded towards the bottom of that range for about a week and a half, almost 2 weeks, right? You can see the next day we traded right around that range, traded above it, then slightly below it, then back above it, and then as we came up to the top of that range, you can see the market wasn't ready to really move past it, and so we headed all the way back down, right back to the bottom of that candle. And these kind of candles, they leave an imprint on the market, because this is, again, the market is really nothing more than a collection of its participants' views on what price should be. And when you have these really emotional impact days, they tend to leave an imprint on the chart that you can see. And what we finally did was we were finally able to break above it. So the market was able to move past the fade and the lack of trust on that vaccine news. And we finally were able to break through that. And so this becomes a critical area. And this is what led me to believe that we're ready to start rallying. Matter of fact, I was expecting the rally right before that happened. But as we move forward, you can see we've broken out, and because we've left that behind, that should now become a support zone. So even if we see more red candles, even if this little rising channel that we have at the moment in the short term doesn't hold in the long term, we still have good support developing here at 364. If we do have another couple red candles and come back down to that price, we have the 20, which again is fanning out and spreading out from the 50, showing that a trend is really starting to develop, and that should also act as a potential support zone for the price action. So I'm not really expecting a drop here. We don't really have a lot of news hanging overhead on the market that could lead us to dropping. Clearly we have a lot of bad coronavirus news, but because the market is so optimistic about the vaccine, at the moment it's ignoring any real news concerning the coronavirus spreading and having another wave and more infections and all that kind of stuff. That's not really affecting the market right now. And I think in reality the only real negative would be if we had really bad vaccine news, or if we had a rash of deaths that really started to spook market participants again, and that's not really what's happening right now. And so when that's the case, we tend to just trade off of technicals when the news isn't really affecting the market. And so with that said, the technicals are all very positive. Like I said, we are trading above our previous range of consolidation, and it's not just this little triangle from November to December. As we pointed out last week, really, we're trading above the range that we spent almost all of the summer in. You go ahead and take a look from August and September and October and even a lot of November. What were we trading at? We were basically trading between about 360 and about 320 on SPY, and we were able to break out above it. We were able to change that previous resistance into support, and that's why we've kind of broken forward. Now, even if we drop a little bit past the 20, we've got support down here around the 360 range, which should hold as an area for buyers to go ahead and step up and try to play to the long side. So I think overall, again, as I mentioned last week and the week before that, all systems are go for us to go ahead and rally into the holidays and into Christmas. Typically, at the end of the year, you have more benign price action. There's a few different reasons for it. Obviously, the cyclical nature of it, and with the holidays coming, you're going to have less volume in the market. You're going to have less market participants because a lot of the bigger firms tend to, have their traders go on vacation. maybe leave some of the junior staff. On top of that, you have the idea of the economy being boosted by Christmas sales. And generally speaking, for the most part, the market is usually optimistic in December. It doesn't always happen that way. Of course, that's the way these cyclical things happen. They tend to happen more often than not, but they don't always happen that way. But it's looking like we are working towards a Christmas rally. And if that's the case, we should expect benign price action over the next couple of weeks, which means even when we do correct, it should be pretty shallow, and it should be orderly, and it should give us good buy the dip opportunities. So that's going to be the focus for us. Now, again, we're going to go over all four of the major markets, only the S&P, the NASDAQ, the Dow, and IWM. And once we look at all four, we'll kind of come to a consensus as to what we think of the markets in general. But as far as how we want to trade this, I'm just going to go ahead and say right now, we should be looking to buy dips, and we should be looking at names that are coming out of consolidation. The one thing you don't want to do is chase this pattern, right? So you don't want to look at charts that are mimicking the S&P 500 right now and have these rising wedges, because at this point the risk reward is poor. There's a pretty good chance that we continue climbing upwards, but if you're trying to trade this, it's not an easy trade, because in reality, say we were trying to trade the S&P 500 right now through SPY, right? And you tried to enter here at the bottom of this channel, you've got an entry right around 368. Well, what's your potential profit target? The top of the channel, maybe around 370, 371. What's our stopping point? Unless you're going to be very, very aggressive and stop out right below yesterday's lows, really our stopping point's all the way down here at 364. So we're looking at about 4 points of downside and maybe 1 or 2 points of upside before we have to go ahead and contend with more resistance. So this is not where you want to go ahead and get long on this type of pattern. What you want to do is you want to find stocks that have already done this pattern and have come back down and are retesting this zone. All right, that trend line really wants me to pick it. All right, so you want to find stocks that have already broken out and are right back here retesting support, which at this point gives us really good risk reward, because at that point we have maybe a point of downside and we have a good 6 points of upside. Or you want to find stocks that are still in their consolidation range and trying to follow the markets upwards. So that's the way you want to go ahead and trade this type of environment. But let's go back and take a look again. We're going to look at the key levels on the SPY, and then we'll move on to the NASDAQ. So key levels basically have been outlined just through the analysis that we've already done. We have key support here at 363, maybe 364, right in that range, right as the 20 period comes up to meet it, as well as the top of that candle, which again is very significant from November 9th. If for whatever reason we do have a really negative market and we do break through that, we're probably going to come back down and test the 50-day moving average, and that is likely going to occur somewhere around here in the 355 area as we head up and test some of the previous highs from back in September. Now again, I'm not expecting this, but you always want to have an idea of what could possibly happen. And if we have a negative market, that's probably about where we can expect the pullback, is down to that range. And below that, we have major support down here at 342. I would not expect us to lose this. And again, this is another significant price zone because of the impact that a major candle had on it, which again, the last time we had a candle as significant as this one from the vaccine news on the 9th, was this candle back on September 3rd, which was an important selling candle because, again, it was what finally started to put an impact on these three rising wedges and the rally that we had from all the way back in July to September. And this became a critical turning point in the market, was this 342, which was from support turned into resistance and then eventually back into support. And we really haven't come back and tested that, and that's going to be a pretty key area to test. But again, I don't think that we're going to see that, probably not this year, probably something we're going to have to revisit at some point in 2021. But I think for 2020, in my mind, the likelihood of us coming back down to that are pretty low. I think what we should be looking at right now is focusing on just these shorter term support zones that we pointed out. Now, as far as resistance, you know, there's really not a lot, right? Other than the previous highs from today and yesterday and the top of this little channel here, everything else is theoretical, and there's really nothing upside because, again, we're right below all-time highs. So basically, as long as we continue chopping upwards, there's really no resistance after that, and it's basically just theoretical. So overall, like I said, we're in a bull market, and what we want to do right now is make sure that we are taking advantage of this, but staying disciplined and not allowing the market. What the market likes to do in these types of environments is, rather than scare you by dropping to and breaking through levels of support, it tries to scare you by putting the fear of missing out into you, which I think in a lot of times is a lot worse than the fear of loss. And it tries to get you to chase price action. And then eventually, what ends up happening is what we're seeing to a certain extent a little bit more on the Qs than on SPY, which is you get the string of green candles, right? And so what happens is the more and more of these candles we get, the more you have people chasing the price action, and then those are the traders that get shaken out, and that's how we end up getting these moves like we saw back in September 3rd, where you start to get these quick red candles to shake out all the traders that kept chasing the price action upwards. Now, is that going to happen here? Maybe, maybe not, but I think even if it does happen, like I said, we're expecting pretty stable support at the top of that candle from back on November 9th, which again, as you can see, is the top of this triangle pattern that formed on the Qs. Now, the NASDAQ has, for the last month or so, or last maybe month and a half, it's been relatively weak to what we've been seeing on the S&P 500, and more importantly on the Russell 2000, and to a certain extent even the Dow Jones. It finally started to pick up a little bit of steam. I'm expecting more strength to come into the NASDAQ before this year is over and before we get to Christmas. It hasn't happened yet, but I am expecting some of these FANG stocks like Amazon to rally. And for those of you that follow me on Patreon, you'll know that's one of the stocks we're looking at this week. And last week we were looking at Netflix, which actually did provide us with a pretty strong move to the upside. But generally speaking, a lot of the FANG stocks are still lagging, which is why we're going to see the Qs kind of slowing down a bit. Now, overall, it's still in a very good place, right? We're still, I mean, basically we printed new all-time highs yesterday, and we opened up today and almost made new all-time highs right before we dropped, right? So the fact that this candle is red and we're trading down today doesn't mean that the market is ready to correct and we're going to drop. It's the first red candle in what, 2 weeks, 3 weeks? It's bound to happen. Eventually you get these traders that chase that are going to get shaken out, right? And now the question is, how far does this shakeout occur? Are we going to close strong and then just print a doji candle and then trade sideways for 2 or 3 days and then try to break out? Or are we going to come back and retest the 20 and retest this 297? I think it's really up for debate at the moment, despite the fact that, again, we're kind of pulling back right now. Again, if we look at the 5-minute, you can see it looks like the market just started taking a turn downwards. Maybe there was some news that came out or something, but until I see more, I'm not concerned with this. And like I said, really what we're doing right now is just kind of getting our first sell-off after so many days of green action. And what we're doing is we're coming back and we're going to probably test the previous highs from back in September. And then from there, like I said, either we find some buyers into today's close and we just print some kind of a doji or another hammer like yesterday, and then maybe trade sideways for a few days. Or if we have too much selling over the next couple of days, we're going to come back and retest this 297. Now, 297 should still be very strong support. It's going to be the 20-day moving average, and that should probably be a spot to find buyers. And again, I'm looking at buying dips here. I'm not looking to sell this. I'm not looking to close out stocks because I'm worried about the market correcting. I think generally speaking, all the signs are pointing towards us continuing to rally. So I'm going to play it that way until things change. Now, when will things change? Well, when we start to lose some of these key zones, like for instance, this level that I've already pointed out 3 times, which is the top of that candle from November 9th, which again is the top of this triangle, which again is also the 20-period moving average. We trade below that, well then maybe I start to reassess where we stand. However, even if we do that, we're still above very critical support, the 50-day moving average, as well as the next key area, which is back here in 284, which, as I pointed out back with the SPY, was an important turning point from September 3rd and September 4th. And until we lose all of this and head back to the 200, I'm not really worried about the market. Now, does that mean I'm not going to stop out on trades because we're up here? No, I'm still going to remain disciplined. I think that's the one key takeaway we want to have from today, is we want to be aggressive and we want to be bullish, but don't lose your discipline. Don't ignore stops. Don't think that the market's just going to erase your mistakes, because even though there's a good, 50, 60 points before we get to a point where the Qs are in trouble, that's a lot of movement for a trader to ignore risk. So despite the fact that the market would still be healthy even with a big drop like that, your account might not be if you're not paying attention to your money management and making sure that you're taking care of the way you manage your account. So keep that in mind. We want to be disciplined, but we want to be aggressive, and we want to trade to the long side right now, and we want to make sure we're buying dips and we don't get faked out and we don't get scared just because we see 2 or 3 red candles on a market index or on a stock. Welcome those of you that have come in. We've had a few viewers step in. Those of you guys that are watching, if you have any questions regarding my approach to trading or why I'm saying the things I'm saying about this, feel free to ask. Feel free to interact in the chat. Also, if you have a chart you want me to look at, feel free to type it in there. When I finish looking at the markets, we'll spend some time looking at the charts that you guys have. So if you have a stock that you're looking to trade, or even if it's a stock that you just have a question on, just ask, and I'd be more than happy to go ahead and cover it for you. All right, so that's kind of it for the NASDAQ and for the Qs. The key levels are pretty much everything I just pointed out, and just like the SPY, can't really point out resistance, right? Other than today and yesterday's highs, there's no other resistance because those are all-time highs. So there's no pockets of traders that are underwater. Matter of fact, the only people that are down on the NASDAQ are people that either bought yesterday or the day before or today. Everyone else is up. Everyone else is at a profit. So there really isn't a lot of supply there with traders underwater looking to try to get out. And that's something to keep in mind. Now, next up we have the Dow. The Dow Jones, as you can see, is following what the S&P 500 and the NASDAQ are doing. Maybe not quite as aggressively, stalling out a bit. We were seeing a little bit of strength come into the Dow as it plays catch-up, but for the most part, you can see it's starting to slow down a bit. It's the same thing, right? If you really look at it, it's the same exact pattern as SPY and the NASDAQ, just not quite as extended and a little bit more volatile. And like you saw with the NASDAQ, we had about 9 or 10 green candles in a row. You can see the Dow, there's plenty of red candles in here as it's tried to make its way up. So, some of the components of the Dow are kind of struggling a bit, and that's kind of holding it back and kind of keeping it from really rallying as strongly. However, despite that, these were still all-time highs. It's still above the range that it formed throughout August and September. It's still above the triangle that we've printed over November. So it's got check marks on all the key boxes, right? It's doing everything positive that the other indices are doing. It's just not doing it as boldly as maybe what the Qs are doing or the S&P 500. But other than that, it's right in the same place. Again, look at the 20 period and look at the 50. They had this nice coiling action. They've broken out. They've spread out quite a bit. Matter of fact, to the point now where the 20 period is starting to slow down and get a little bit of a wave going before it probably tries to continue going upwards. Again, this is an indication of a trend that's starting to really develop. And when these kind of moves happen, they usually persist for a while. So there's a good chance that this rally will continue further. And all we have to do is make sure we stay disciplined and that we are not we're not timid when we get buying opportunities, and we make sure we take advantage of them. And again, just like we saw with the other two indices, with the S&P 500 and the NASDAQ, we'll know when it's time to take the foot off the accelerator, right? There are key technical areas that, as long as they're not violated, we can expect the market to behave in a good manner. And if they do get violated, that's when we go ahead and take the foot off the gas and maybe put it on the brakes and wait to see if we need to step on it as we coast and see what's going to happen next. But at the moment, foot should be on the accelerator, and we should just be looking to trade to the long side with no real concerns other than making sure that we stay disciplined. You don't want to chase price action. You don't want to ignore your stops. All right, so key levels on the Dow. We have the short-term key level is right here at 299, which again is the top of that candle from November 9th. It's also the top of this triangle. The 20 period will likely come up and meet price right around there. So that's going to be a pretty key support area. We're not that far away from it now, but unless we see a drastic change in price action, it's probably going to hold. And if it doesn't hold, we're probably just going to dip slightly below the 20 and then try to come right back up. The next key level of support is the top of this range from August, September, October. And as you can see, we had this area here that flipped from what was resistance around 291 in September, and it turned into support back in November as we had that big gap up and fade, and then eventually the next few days bought it again. So that is the key support zone that we should look at if for whatever reason we can't maintain price action above the 20 and above this area right around 300, just slightly below it. Other than that, everything I said about the SPY and the Qs goes for the Dow, so I'm not going to spend too much more time with it because it's basically just following and copying what the other two indices are doing. The last one we want to look at is IWM in the small caps. Now, and this one has actually been very strong. And again, you can see, look at the difference, what we just saw in the Dow compared to what we're seeing in IWM. Um, Very strong price action. If you look at the triangle, and we look at where we were on November 9th compared to where we are now, you can see that there's been an explosive move in IWM, and I think this is important. And this is one of the things, those of you that follow me, those of you that come here on these Wednesdays, we've been on top of this, and we've seen this rotation of capital away from stuff like the NASDAQ and the Dow and into small caps. And this is a good sign, because this is traders willing to take risks. This is traders willing to hold volatile assets, which the small caps tend to be more volatile and more risky than what you might find on the S&P 500 or the Dow, for instance, or even nowadays in a good portion of the NASDAQ. The NASDAQ used to be associated, and probably still is kind of associated with risk, but with the big mega tech names like Facebook, Amazon, Apple, Google, Netflix, they take up such a, or there's such a huge weight on the Nasdaq as far as what they influence it with, that at this point you can look at the Qs as a safer index, and it's not really a proxy for risk like IWM is, or like the Qs used to be. And so I think IWM at this moment, in my mind, is the one index that we could really use as kind of a measure of the risk appetite of the market. And the fact that it's actually breaking out, the fact that it's been strong since back here in October, shows that the market has been willing to assume risk. And this is part of the reason why I've been pretty bullish as we've moved into the holidays, is because of the improvement in the behavior of the small caps through IWM. And until I see a change in this, I'm going to expect this to continue. And that's why I've been really harping on a rally, and been looking for rally for the last few months, is because of the change in character that we've seen on IWM. Again, take a look at when the moving averages start to curl up. Look at how clean they are, moving up with some train tracks. Price action has come nowhere near them. We're getting bounces before we ever approach the 20. Everything here is the clear hallmarks of a strong rally, and nothing has changed. And so until that changes, we can just assume that the market's going to continue rallying, and that the small caps are going to lead the way. When we start to see erosion in the small caps, that might be our first warning sign. However, when we first see erosion in the small caps, it might be indicative of a rotation into tech rather than the market, or rather than the rally dying. So we need to keep that in mind. But for now, I think IWM is the leading index, and it's the one we want to pay attention to as far as what the market should be doing and what it's going to be doing. And so as you can see, we broke out. We broke out last week, and we've broken out this week. You can look at yesterday's move. You can look at today. I know today's a red candle, but we're printing new all-time highs. We're trading right around yesterday's highs, and it's nothing negative here. There's nothing I can say here that points to anything that a trader should be nervous about. And so really the only thing is managing your risk. That's the only issue we have right now, is making sure you're not chasing price action. That was the only concern I had on Monday when I was looking for potential trades, is just that you don't want to buy a stock that's trading at highs unless it's trading in a consolidation range like maybe it was a couple weeks ago, where you can actually manufacture good risk and reward based off the chart pattern. But when you have a string of up candles like this, you can't really go ahead and go long here, right? Because again, unless you just take an arbitrary stop and say, well, I'm going to stop if it goes below today's lows, the next level of support is, the closest one you could mention is down here 187, which is 3 points away, but really it's probably down here 184, which is 6 points away. So you'd have to look for this move to be extended another 6 points, basically double, for you to get one-to-one risk on this kind of a trade if you just wanted to buy IWM today. So that's the one real problem we have, is that we want to make sure that we aren't chasing price action. But when you have a market like this where you get a little bit of a different vibe, if you look, the picture is slightly different between the SPY, the NASDAQ, the Dow, and IWM. They're all printing very similar patterns, but with different levels of strength. When that happens, you can find areas of the market where money's rotating back and forth, and so what we want to do is we want to find stocks that either are still here and are still waiting to chase or follow what IWM just did, or, as often happens, there are leaders that move before the market indices do. And so there are probably stocks that have already consolidated, they've already broken out, and they're already on their way back and retesting and reconsolidating, getting ready for the next move. And so those are the ones that we want to keep our eye out for, rather than chasing the price action on a stock that's doing whatever IWM is doing. And so that's really what we want to do. Now, key levels on IWM before we move on to the dollar and then to chart requests. First level the index is this strong. The first level of support is down here around 187, 186, and it probably holds. This is probably where we're going to consolidate. If we have a string of red candles, it'll probably just come to here. The more major support is, again, what we already pointed out, down here 184, which will be right around where the 20 will come up to meet price if that happens. And then below that we have 178. But when you have an index or a stock or an equity that's this strong, usually the moving averages are the first reference point that really makes a difference. So we'll keep an eye on the 20, we'll keep an eye on the 50. And obviously all this price action from August, September, October, November, that's all in the rearview mirror right now. And that again shows just the strength that we're seeing here and just how much room we can correct and still be in a bull market. And that's why we need to stay disciplined, is because there is a lot of downside if you decide to ignore your stops and you decide to ignore sound money management. There's a lot of room to the downside where we're still in a bull market and where it's still in a healthy state. So make sure that you don't let the market take advantage of you if for whatever reason we start to see red candles. Make sure you stay disciplined. All right, so that's the four major markets. In case you can't tell by now, I'm pretty bullish. I think that we will continue to rally, and it's just a matter of making sure that we don't overstep our bounds and get a little foolish with our trades. But if not, we should be good to go, and just make sure that you aren't timid when we do get red candles, and you go ahead and take advantage of the price action. Let's take a look at the US dollar real quick. We're not going to spend a lot of time on this because it hasn't really changed too much from last week. We did see a little bit of a bounce. As you can see, we've got 5 green days in a row, but it hasn't done much. It's more of a dead cat bounce where we had this major breakdown, and we're just starting to kind of bounce a little bit. But it hasn't really done much to signify that the US dollar is really ready to stabilize and form a bottom. It actually needs to go quite a bit up, all the way up to this 24.85 level, before it can even begin to challenge and get back into its range. So there's plenty of room for it to bounce and still ultimately fail and head back down south. If we look at the mirror image of this, which is the euro chart, you can see the euro has broken out very strongly versus the US dollar. And despite the fact that we've seen the US dollar finally kind of fight back a bit over the last 4 days, this is still a bullish chart for the euro, which means it's a bearish chart for the US dollar. Much like the stock market, you got the 20 and the 50 starting to branch out or spread out and curl upwards, which is indicating the possibility of a strong trend developing. So there's very good chance the US dollar continues to struggle. If we look at the US dollar versus the Canadian, we can see it's struggling very, very strongly against that as well. Even though we've got 2 or 3 green candles, it hasn't done much. It hasn't made up any ground. It's got a very negative trend to the downside, and it's lost a lot of key supports. So again, not looking good. And if we look at the US versus the yen, this is the one chart that doesn't look terrible for the US dollar. It's still at lows. It's still trading at the bottom of a range, but it still has a downtrend. But at least it hasn't actually broken down. So I think if anything, this just tells you that the yen is weak also. Not that the US dollar has any kind of strength. It's just that the yen is keeping up with the US dollar as far as weakness is concerned. So what does this mean? Well, this bodes well for anything that's priced in dollars. That's partly why the US stock market is doing so good. That's partly why Bitcoin has been doing so well. And to a certain extent, why gold and silver have started to pick up a little bit of steam. Now, gold and silver have not behaved as strongly as you would have expected considering the weakness we've seen in the US dollar. I'm not 100% sure why this is happening, but that's what the chart is showing, and so that's how we have to go ahead and analyze it. And as you can see, we've got a rollover here, right? You can see that clearly we had this nice strong triangle, we had this support zone, and it turned from support to resistance, and now we flipped down and we're trading even below the range that we formed below that level, right? So this is still not a bullish chart in the short term. in the long term, this is still bullish, uh, right? If you take a look at what's happened in the long term on gold, it's still looking good, right? It's just that in the short and intermediate term, it's been really struggling lately, and it's questionable as to why it's happening. However, if the U.S. dollar weakness persists, then this should eventually flip back to a bullish chart and should give good opportunities to trade now. Right now on GLD, this is not a good look. Again, we've got this range. We had the move up into it, and it failed, and it's back below it. For those of you that are bullish on gold or silver, you want to see it get back above 174. More importantly, you want to see it break back past the 50-period moving average. But at the very least, it needs to get back into this range, at which point it can start making its way up and try to test 180. Silver's actually a little ahead of the curve when it comes to that, but again, you can see it came up just like GLD. It came up and tested a critical resistance zone, and at the moment has failed that test and is back down below it. So until we see a new breakdown in the U.S. dollar, I don't expect a lot out of gold and silver. But if the U.S. dollar turns south, I think there's a very good chance that gold and silver actually make their way back above these critical resistance zones and start to start making their way back up towards positive areas. And so keep an eye on them and see what happens with the U.S. dollar. Because again, the weakness in the dollar has really affected these. And before we get to oil, I will again point out Bitcoin. This has been one of the stronger areas as far as the inverse trade to the dollar. And it's had a massive move. Now, unfortunately, it's not a good spot to buy because, again, it's at major resistance. And it's already, I mean, it's almost doubled in price just from back in September. So it's a tough trade right now. But for those of you that are into this kind of stuff, you should be looking for a bigger consolidation out of Bitcoin, and then maybe see if you can get some, because it's starting to really perk up, and there's a decent chance that it will print new highs at some time soon, between now and maybe the first half of next year. And then so finally, the last commodity we want to look at is oil. And oil has continued to break out. We pointed this out last week. I think the oil trade is still looking good. And I think more than anything, this shows that the market still has confidence that we're going to continue to open up our economy, because the anticipation of an increase in energy demand is still here with oil futures. And so this, I think, it more than anything shows that. I don't know that there's room for an explosive move to the upside, but there is room for it to continue challenging up and maybe getting into the 47, 48 range. As you can see, we had the nice breakout, we had the flag, we had another breakout and another little flag, so it's kind of stair-stepping upwards. It is finding resistance. You can see all the wicks and all the little skinny points of these candles showing there's a lot of indecisiveness as it tries to make its way up, but it's still slowly crawling upwards. At this point, it's very clearly above the previous range. So even if it drops, we can look at 43 to 44 now as a good support zone. And oil-related charts that are doing similar things should give us similar types of price actions. So if you see an oil name like a gas station or something like that, or an oil driller, and it has the same thing, it has this big base and it has a breakout, as long as we see crude do the same thing and just kind of stay above that, I would expect those related names to do sort of the same thing and stay above them as well. All right, so that's oil, gold, silver, dollar, all the good stuff. Let's move on to the chart requests. Again, those of you that are in here, I'd love to hear from you guys. Let me know what you're looking at. Let me know what your thoughts are. Do you agree with me? Do you disagree with anything I said about the markets? Any kind of thing to further discussion would be very welcome. All right, so Fat Boys, let's take a look. The first one you wanted me to look at is GDRX. Recent IPO. I don't know what this one is, but it's a tech stock. Not a really good IPO, I guess, right? Well, it was a good initial IPO, but not doing really good right now. All right, so usually when we get these stocks that are recent IPOs, right? So the first thing you want to look at is, of course, the IPO day, right? These become very significant. Just like I mentioned in when we were looking over the markets, how certain candles hold a lot of weight and they become reference points for the chart. So this was obviously this is going to be a key reference point for this chart, right? To a certain extent, the highs were as well, although they don't really. It doesn't look as clear on the chart right now. But this was actually a pretty important inflection point as well, right? Once we broke above it, you can see it got volatile, came up, kind of formed a double top where it couldn't hold above that level, and then eventually rolled right back over. And then each time it tried to get back above those IPO highs, it failed. And then eventually led to what happened here during its earnings, its first earnings report. So I'm going to get rid of that one trend line. I don't think we need it anymore, or at least not for now. But just pointing out, these candles have a lot of impact on on particular stocks. So the next important candle is going to be that earnings candle, right? And so now we have the two new reference points for this, which is the highs from that gap down, and of course the lows from that gap down. And it's right in the middle of that range, right? So I'm not sure what your thoughts are on this, what you're looking to do with this type of a trade, but I think the roadmap is pretty clear just by looking at these two candles, by looking at the IPO candle and looking at this candle from after the earnings gap down. You want to buy the bottom of this candle, so you want to buy around 35.80. You want to sell the top of this candle until it flips into support, right? So at the moment, this is not a buy, and it's not even a sell. I don't think that there's anything you want to do here. If it comes up into 40 and fails again, it's probably a short all the way back down to 35. This is a stock that's not doing good. It's in a negative state, so I don't think shorting it, there's anything wrong with it. However, I know you're looking at buying this, so what I want to point out is if you want to buy this, it's very simple. You either want to buy it when it comes back and tests 35 or 36 again and make sure it doesn't break below that, or you want it to break above this 40 and come back and retest, at which point you can go ahead and buy it, looking for a move to fill that gap around 45. You should not be thinking about the 55, 60, 65, whatever. That should not be anything you're thinking about right now. All you're thinking about is, can it move from station to station? Can it move from 35 to 40? Can it move from 40 to 45? If it gets above 45, then can it get its way back up to 50, right? So it's got these $5 increments that have become pretty critical price zones. And the first step in any chart, excuse me, the first step in analyzing any chart is identifying these points, right? The support and resistance zones. Then from there, we look at the patterns that could give us particular triggers. There, at the moment, we don't have a pattern. There was a pattern not that long ago, right? So if you take a look at what happened here, we had the test of 40. We came back and we tested down to 35, and then we broke that downtrend and started to bounce. So that would have been a tradable pattern. But at the moment, we don't have a tradable pattern. We have this trend line here, which gives us a potential trading pattern. However, it's not worth buying this trend line because it's already halfway up and the real support zone is way down here. If anything, this trend line might give us a short opportunity as it comes back to the top and it breaks down. However, we're still in a strong bull market, so even weak stocks like this, I'm still hesitant about trading them to the downside. But if not, we have to wait for another kind of consolidation pattern to form back down here in the 35-36 range, or again up here around 41, where maybe we get a bounce and then we get another descending trend line. We can go ahead and try to take a trade and try to make our way back up. But at the moment, there is no tradable pattern that I see that's worth taking here. So this is something you put on your watch list and you watch how it navigates these zones. But these are the critical zones. And I think it's pretty clear on this chart what the critical areas are that are support and resistance. And so it's just a matter of, as it approaches any of these levels, finding a candle pattern or a chart pattern that gives us a hint as to where it wants to go next. Okay? So next up, you want to look at Johnson & Johnson. All right, so on Johnson & Johnson, now let me know if on any of these, I'm assuming that these are stocks that you're looking to enter, but let me know if any of these, maybe it's that you already have them, and then that way I maybe have to change what you're looking for. I like what I'm seeing out of Johnson and Johnson, but again, there's no trading opportunity here at the moment as far as swing trades are concerned, or short or long term trades are concerned. Um, you take a look at it. We're going to zoom back to basically April, right? Since we had the correction and the bounce from the coronavirus, and made our way back up. Johnson and Johnson has been trading in a very defined range, right? So let's go take our rectangle and highlight the top and the bottom of that range. Bottom of the range is, it's a little bit more fluid, but I'm going to go ahead and say it's this, right? So as you can see, Johnson and Johnson has traded in a range of about 136 to about 156 since April. So for the majority of the year, right? So you don't own this, you're looking to buy it. Now, so here's the issue. I don't know if you want to buy this short term or long term. Names like Johnson and Johnson tend to be more longer term trades rather than short term swing. But in either case, we don't really have a good entry here. If you're looking at this as a long term trade, you want to buy this when it's back down towards the moving averages, especially when it's a range bound stock like this. You want to buy it when it's at the bottom of the range, not even the middle of the range. But generally speaking, at the very least, you want to buy around the 200-day moving average, or there is a nice support zone here that is held. There's kind of like a line dividing the range. And this, by the way, this happens very often when you have these ranges like this, like 156 and 136. A lot of times you can see it's very close to 146. A lot of times the middle also becomes a good support and resistance zone. As you can see, it was really good support, then turned into resistance, then back into support, and then into, well, there wasn't even resistance, so support and then resistance. So the middle line often becomes a good zone as far as buying and selling. So if it were to come back into all these moving averages and back into the 145, 146 range, it's possibly worth a buy. Is it worth a buy right now with overhead resistance just 4 points away, and we've got support 7 points away, and then possibly, what is that, 17, 18 points away? I don't think it's worth buying here. I don't think that this is a good spot to buy. Again, we don't have a good candle. We're going to get a little more. Let's get rid of this rectangle for now. And let's zoom in. And if you think about it, we don't even have a good pattern to buy right now, right? This is exactly what I was saying before about how we don't want to chase the price action. So we've got this rising channel, and it's at the top of the channel, right? So our risk reward here is just not good. Now, the one thing you can look at this and say, well, it was trading in kind of a triangle, right, or a channel, depending on how you want to draw it. Even that is not really a great pattern to trade, because this is kind of like a broadening wedge. So even along these lines, it's not really giving us much. However, I can see someone saying, well, this should flip from what was resistance to support. And so you could look at maybe wanting to buy 150 once it kind of finishes with this wedge here. But I would say right now this is a sloppy chart. It's in the middle of a range, and it's not really anywhere near a level I'd like to buy. And on top of that, I don't see, this is not a good pattern, a good consolidation pattern to buy. So what we have here is we have stocks that are, oh, by the way, hi, JD Bird. I think you're one of our new Patreon subscribers, right? Welcome. I hope you like what you're seeing so far. I'll take a look at BABA in a second, and I'll let you know what I think about it. Great, awesome. Glad to have you here. I'm not sure. Did you find me through Twitch, or I'm not sure how you found me, but I hope you like what you've seen so far. And just whenever you have questions, feel free to ask me. JB, you're from Discord. Okay. Sometimes following these names gets a little tricky for me. All right, so you're from Discord, so you know who I am and you know what I'm about. Okay, cool. Well, hopefully you like what we've done so far. And yeah, feel free to ask whenever you want. Whenever you have a question, feel free to ask. I'm always willing to help out. All right, so Fat Boys, back to Johnson and Johnson. I don't see a pattern here that I like. I like the stock. I think the stock is strong. clearly it's in a range. So when it's in a range like this, you want to buy the bottom of the range. And this is what I said before about discipline. You don't want to chase price action, and you don't want to be timid when it comes back to support. What happens in stocks like this, as we zoom back out, what happens is traders look at this and they're like, oh man, I can't believe I missed this opportunity to buy this in the 130s. And, so for instance, let's go back all the way to April, right? And of course, a lot of people miss buying in this in 116, 120. But there was a point here where traders were probably like, oh, if I would have gotten 130, that would have been great. When it comes back down to that price, they get scared and they don't buy it. And then it comes all the way back up, and then they finally panic and they buy it at the highs. And then it comes back down, they stop out. And when it gets back to support, they get timid again and they don't buy it. And then they lose their discipline and they buy it at the highs again. And this is the kind of thing that happens to traders everywhere. And when you see a stock that has a defined range, you have to play the odds, right? And odds are that when it gets to the top of the range, it's not going to continue upwards. And when it gets to the bottom of the range, it's going to get stuck. Now, there are, of course, times when it flips and it breaks through these ranges. When that happens, there are oftentimes patterns of consolidation where you could go ahead and try to play the breakout, or you could wait for a retest of the breakout, and vice versa with the breakdowns. And that's when you go ahead and try to play those. But at the moment, as it's approaching this, off of what it's already a rising channel, it's just not. It's not a good. It's not a good trading opportunity. It might be a good stock, and it might be a stock that's going up. But as far as how we manage our risk, how we manage our own mental capital, it's not a good. It's not a good trading opportunity yet. Okay, so we'll leave it there. Put it on your watch list. And wait for it to give you a pattern that's a little bit more tradable. You can ask me maybe in another couple of weeks, and we'll take another look at it and see if maybe it consolidates and this does become a support zone that we can look at for a trade back into the highs. Okay? All right, so let's take a look. You had one more, I think. CNR. And then we'll look at Alibaba. All right, so Cornerstone Brands. Manufacturers. All right, so we got a similar scenario here. You look at this now. It's a little bit different because it is trying to break out, right? But let me look. So this is what it's done all year, and let's take a look at the long term. All right. Let me do the weekly so it's a little bit cleaner. All right, so I don't know if you ever do this, but a lot of times, especially when it's a chart I've never looked at before, I like to go back and look as far back as I can to get a good idea of what the chart is really doing. And this is actually pretty interesting because we have, if you really think about it, we come back and we take a look here. Now we do have, again, it could be, depending on how we want to judge it, we can come back and judge it from, as a matter of fact, I'm going to go ahead and do that. I'm going to judge it from this reference point here. Let me make sure that's perfectly horizontal. Alright, so this was a major breakdown all the way back in 2018. It came up and at the beginning of this year, it actually tried to break out before we had the coronavirus drop, right? We're back to that zone again. So this is an interesting chart in that it's at very, very strong resistance. So again, the discipline here. Do we want to buy this right now? Now, I will say one thing. This one, there's a potential for it to be a breakout trade, depending on what it does next. Would I want to buy it today? No. And the reason I wouldn't want to buy it today is, again, 1, 2, 3, 4, 5, 6 green days in a row into resistance that's held in place since 2018, right? Last time it hit that zone, look at the same thing, and it was the same thing. It ran up into this and then failed, right? Now, when do you want to buy breakouts of these types of ranges? When you see the stock hold up above it. So what we have here is, it's actually kind of interesting because we have a little cup and, well, it could be a cup and handle, right? You've got this nice little you've got this nice little bounce, right? So we came up, we bounced, we hit this, we failed, we curled right back up, and we're back for another retest, right? On top of that, we've got this. We're just gonna put trend lines all over this chart, okay? We've got this here, right? We've got a definitely momentum building towards this breaking out. Now, if we can get a handle here, if we can get something like this, right? And it consolidates just below the highs or just above the highs, right? Maybe we get one green candle, and then we get something like this forming, right? And what I'm going to do is I'm going to color these green to show you exactly what we're looking for, right? If we could get a consolidation at this range like this, and then a breakout past it and past this zone, well, then we got a breakout trade, right? And that's how you want to go ahead and trade these multi-year resistances or these highs from a range. Is you don't want to buy it when it comes up 6 days in a row into resistance. It's very likely to fail as it does that. Can it break out through that? Sure. But if it does, then wait for the retest. Wait for it to eventually pull back and retest it. And at that point, then you have a good support area. You have a better place to put a stop, and then you have a potential target based off the long-term chart. So what I would be looking at on this one, I put this on my watch list, and I would watch. And there's a few different ways this could play out, right? Because if you look at it, we also have a channel forming here, right? We'll change that back to the color of all our other trend lines, right? We also have a channel forming here, and it could be that it comes back, tests the bottom of the channel, and then comes up, and that's how the handle is formed. Or what? Even if it's not a handle anymore, and it's just part of a channel, right? But if it comes back, bounces at the $9 range, comes up and then breaks out again and stays in this channel, then we can look at it as a possible bounce play. Again, depending on where our risk is here, right? If this comes all the way back down and this channel can hold as our stopping point, well, then we got good risk reward at a certain point for a breakout trade. So there are potential signs here of this breaking out, but keep in mind, in the long term, this is still pretty ugly, and there's still a pretty good chance it fails here, right? So we don't want to just jump in ahead of the time, hoping it works out for us. But there are signs that this could break out, and if it does, it would have to hopefully do one of these things to give us good risk reward on the entry. Okay. So hopefully that gives you a better idea of how to conceptualize a trade at the top of the range. Typically, like I said, you don't necessarily want to trade the top of the range because more likely than not it's going to fail. But when you're in a strong bull market, these levels get broken, quite often. And it's an idea. The idea is you want to make sure that you are trading it in a way in which you're giving yourself the best chance of success. And if it fails, you're giving yourself the least chance of getting hit hard when it fails. And so you don't want to buy now, because if you buy now, there's a potential that it does bounce 30 cents and then fails, and there's the chance that it pulls back $1 and then still works. And so you're giving yourself $1 downside and maybe 30 cents of upside before you have to make your next decision. And that's what's important. Like I said earlier, I don't know, maybe you guys caught on that, but you want to protect your financial capital. You also want to protect your mental capital. You want to make sure that you're not putting yourself in place to make terrible decisions that affect your next trade as well. And a stock like this could be tough because you could buy it today and it pulls back $1, and then you have to figure out, do I want to stop out now or do I want to keep holding it? And invariably with trading, for whatever reason, it always works this way. If you hold it, it's going to break down and keep going down. If you sell it, it's going to bounce and come right back up. And in either scenario, you're going to beat yourself up about it. So you want to make sure that you already know what decisions you're going to make, and that they're not decisions like this where you have to give yourself $1 downside before you figure out what you want to do with the stock. And you also don't want to give yourself 30 cents of upside before you have to figure out what you want to do next. So hopefully this gives a better pattern in the next few days that gives you a better risk reward opportunity and a better trade setup that you can kind of construct and give you clearer decisions to make. Okay? All right, JB, let's take a look at Alibaba. All right, see, so Alibaba's got a nice consolidation range. Even if it's not looking strong, we have a better reference point to make some decisions. So first things first, let's take a look at the longer term chart. It's been a while since I look at Alibaba. All right, so long term it actually doesn't look bad. It actually looks pretty good, right? And so what we have here is we had a nice breakout, and we are testing a pretty important zone here, right? So we come back and we take a look here. And you can see this was back in July. We gapped up to that level, and that became an important zone that we were struggling with, right? 266, 270. Eventually we broke out, and that turned into support. Pushed all the way up to the 300s, which was unsustainable, came back down, and we've been hovering right around that area, trying to redefine that as support. That's right where we're testing right now. Let me make sure this is horizontal. All right, so checks one box, which is that it's at support, right? Even though we failed support recently. So now let's get our pattern going. All right, this is the short-term resistance. It can also be longer-term if we really want to go ahead and point back at what's going on here. It's basically been a downtrend since back in October, right? So overall, again, we're getting to the point where we need to break that. And on top of that, we've got a short-term positive trend, right? All right, so this is the kind of stock that, while it doesn't look great right now, it gives us a good trading opportunity because all the decisions will be made for us by what the stock does today and tomorrow. If we want to trade it to the long side, it's very simple. We want it to trade here. If it's on this side of all this trend lines and all these moving averages, then it's an entry and it's worth buying and it's worth trading. We've got potential targets at 280. We've got another potential target up here right around 286 with the 50-day moving average. We got another target up at 298, which it probably won't make it all the way up to the 300s, but you never know. But on a bounce trade, at the very least, it should come up to 280, and it should come up to about 285. You're looking at a possible entry right around 268, so that's what, 12 points of upside, and then another 20 points, 22 points of upside, right? With downside of maybe 4, right? So I like this I think this is a good trading opportunity. It's not there yet, though. Today's candle's not pretty. Also, what we can maybe look for, a lot of times when you have a triangle pattern like this, I'm going to go back to a chart that I recommended recently. A lot of times when you get to the apex, if you haven't had a move all the way till these two trend lines cross, you usually get a move to one side that's like a shakeout, and then you get to move to the other side. So there's a decent chance we get a breakdown today and tomorrow, but if it gets back above this dotted line around 266, it could get back above this trend line, then it's still worth a trade even if it breaks down today or tomorrow. As long as it's not an extended breakdown. If it's an extended breakdown, then we just forget about it. So if for whatever reason it closes at lows today and then tomorrow it comes down to 260, if the next day it doesn't make its way back up, then you probably just ignore it or just leave it on your watch list and see what happens the next time it tries to challenge and get back above this price action. But conversely, if it breaks out and then heads right back down into this area, then we stop out because it's very simple. It failed the breakout and it's on the wrong side. And is there a chance that it comes down here, bounces, and then eventually makes its way up? Sure, but we can't take that as that's not the risk we want to take as a trader. We're banking on it breaking this trend line and trading back up. If it does so, that's great. But if it fails, then we just get out and we wait for the next trade. We don't want to hope that it comes back down and then change our trade strategy to be like, well, there's still support here and it's still trading sideways. It's like, no, what we're looking for is we're looking for a stock that's ready to break this downtrend and bounce. We're not. I mean, me personally, that's what I'm looking for. I'm not looking for a stock that's range bound and could find support. If you're looking for a stock that's range bound and could find support at 255, then you don't want to buy here. You want to wait for it to come down here, and you want to buy it down here, rather than trying to trade the stock as it comes up to this area, right? So part of it is on how we build our trades and what we are looking for. However, my analysis of this chart is, at the moment, I think that this 265 is a very important zone. If it trades back above it, I think it's going to bounce, and it's likely going to make its way back up into the low to mid 280s, and that's how I go ahead and play this. I do think this one, unlike the other last couple of charts that we looked at, where we just kind of keep them on our watch list and hope that they give us a pattern, this chart is, there's only one or two more days of price action, and then it's going to do what we want it. So just to go back and take a look, so CMG was a trade we were looking at a couple of weeks ago, right? And it also had a triangle, right? And so as you can see, when we were looking at it, it was here, right? And it's right at the apex of the triangle. And so this is what I was talking about, where sometimes you get a fake breakdown. You can see it actually broke below it for a couple of days, but then eventually it broke out. And on this day, this is exactly what we want. We want to shake out weaker buyers, and then we want to break out to the upside. Usually when you get a quick zigzag like that, that tends to give you a good move. And as you can see, we've had a decent move on this. Now, it hasn't made its way all the way back up, but we've gotten to our first target, and we've started to move up. And today's candle, again, the markets are starting to struggle today, and today's candle's not great, but it's still positive. It's still doing what we're looking for. But that entry parameter, that's kind of what we're looking for here with Alibaba, is we're looking for something like that, where we break this descending trend line and we start to make our way up. Okay? So hope that helps, JB. And hopefully, let me know again whenever you want. Just ask me any of the questions on any of the charts we have on our Discord. You can always ask me what my thoughts are on them as they move forward, and I'm more than happy to help and just kind of make sure you guys are enjoying what I'm doing. Okay. I think that covers it for today. Those of you that are here, thank you for participating. Thank you for attending. Those of you that were quiet and didn't ask anything, if you feel like asking in private, you can always ask me on Discord, or you can ask me on Twitter. Just message me. I'll be more than happy to give you any chart advice you want on that as well. And again, it could be a stock you own, or it could be a stock that you're looking to get into. Either way, I think that they're fine. So just to kind of finish with Alibaba, JB, obviously you said you own this at 249. I think that you're fine with that entry. And I would be looking for this. Yeah, so I approached it, I approached this kind of like if you were looking to enter it. But owning it at 249, I think in both cases you're still going to hold. Because even if it comes down to 250, I think that this is still a decent support area. And there's a chance that it bounces there. But I don't think I'd want to stop out here. You bought it at 249. You're looking for a longer term. I think I'd just wait. Because it could come back below 250. But considering it's a longer term hold for you, the 250, yeah, I would just... we'll see what happens here. I think it's going to bounce here. But again, if we look at it longer term, this was a pretty big change in character. And I think even if it comes back down, there is downside. And there's downside all the way down to maybe 240. But I think it more likely than not tries to hold here. Okay? But yeah. Yeah, that's going to be the problem moving forward. Is that's I don't think that's done now. On the bright side, I think with the new change in presidents, that should help Chinese companies get a little more leeway. There's going to be a lot less fighting and back and forth as far as trying to regulate China. However, that's still going to be something in the future, because it's still going to be an issue regulating a lot of Chinese companies, because they tend to look at laws and look at how they approach the consumer a little differently from the U.S. So that might still be an issue. But I also think stuff like Alibaba and Amazon and a lot of these internet retailers, I still think they're the future, and I still think that as long as there isn't any kind of real issue with China and the U.S., I still think this is a good long-term hold, just like I think Amazon's a good long-term hold, because I don't think these stocks just did good because of COVID. These are the kind of stocks that have done good for a while, and I think will continue to do well because it makes sense for people to just buy from home. It's cheaper, it's easier. Um, it's nice to go out and shop, but it's a lot of stuff is just easier to just buy on the internet nowadays. Okay, so I do think this is a good long-term trade and a long-term hold. Now, long-term, um, as far as long-term is concerned, like we said, the one problem with this is there's a lot of room to the downside before it hits major support. But assuming you don't have a full trade on this, I would actually be scaling in, even if, so for instance, you're at 249. If it goes down to 240 or down to the 230s, I would be looking to add, not stop out. And I would be looking at that as a support zone, as the next area to look at. But it would be with the caveat that you don't have a full position already. Okay? But, all right, I think that covers it for today. Again, thank you for participating. Thanks for adding your stocks. And anyone else that's in here, if you missed this, you can always find the replay on patreon.com/StockDarts, where I always post them. And you can always just follow me on Twitter, where I go ahead and post stuff as well. Other than that, hope you guys have a good rest of today, and I will see you again next week.